There's a tax bomb ticking under roughly 2 million senior homeowners right now, and almost nobody is warning them it's about to blow. We're not talking about theory, we're talking about people like Beatrice, a 91-year-old woman with dementia who just lost her $247,000 house because she owed $3,500 in property taxes. An investment firm picked up the place for $14,419 at a tax sale and is now evicting her from the home she owned for 25 years. Beatrice isn't an outlier. She's the front edge of a trend. This same pattern is hitting seniors across the country. And if you understand how it works, you can see exactly why it's not an accident. It's baked in. In this video, we're going to walk through the 3 mechanisms that make this crisis inevitable. We'll start with the safety valve that's supposed to protect homeowners, but actually accelerates their financial destruction. Look at David in Cincinnati. His property tax bill jumped from $1,400 to $4,200 in just 2 years. He's 62, owns his home outright, and told reporters, "I just didn't know what to do. They've put us in a dangerous situation where we're going to be homeless." Think about that for a second. A man who did everything right, paid off his mortgage in full, is staring down homelessness because of property taxes alone. The National Consumer Law Center has a name for what we're watching. They call it the second nationwide foreclosure crisis. The first one in 2008 hammered over-leveraged gamblers and reckless banks. This one is different. It's aimed squarely at the most responsible homeowners in America. People who paid off their homes. People who followed the rules. People who thought mortgage-free meant secure. Let's break down how this wealth transfer is actually working. From 2019 to 2023, property taxes nationwide rose about 24%. The median annual tax bill went from $2,826 to around $3,500 in just 4 years. That number by itself is bad, but the real damage shows up when you compare it to what seniors are living on. Social Security cost of living adjustments haven't kept pace with real inflation. Over that same stretch, benefits increased by roughly half of what prices actually did. Result, seniors on fixed incomes lose ground every single year. Their costs jump 24%, their income crawls maybe 12%. The math only moves one direction. Now zoom in on Ohio, where this crisis is already at full strength. In the 2023 reappraisal, Hamilton County saw home values jump 28%. Butler County shot up 37%. Claremont County went up 30%. And county auditors are already projecting another 13 to 25% jump in the next cycle in 2027. Run that forward. A senior paying $2,000 a year in property taxes today could easily be staring at $4,000 or more by 2028. Over a decade, that's an extra $20,000 to $30,000 in taxes alone. Money most retirees simply don't have. Ohio is just the most obvious warning siren. Florida's property tax surge is so severe it's becoming a political issue, with GOP-led pushes to eliminate property taxes entirely. Those efforts might help the next generation, but they arrive too late for the current group of seniors already in default. New York gives us the wider picture. Nearly 40% of New Yorkers over 65 are cost-burdened, meaning they spend more than 30% of their income on housing. The national rate is about 27%. You're looking at a pattern that spreads state by state as new reappraisal cycles hit older homeowners. If you're getting value out of this breakdown so far, take a second to like this video, subscribe, and share it. That's what keeps this channel alive and lets us keep putting this information in front of people who need it. Now, let's keep going. Here's the first thing that makes this crisis guaranteed, not accidental. The broken safety valve. On paper, property taxes are simple. The county takes your assessed value, multiplies it by the local tax rate, and that's your bill. Straightforward. The trap is in how those numbers move. County auditors reassess property values every 3 to 5 years. During the pandemic housing mania, those reassessments often showed 30 to 40% jumps in a single cycle. In theory, states like Ohio built in protection. It's called the 20 mil floor. When values spike, a reduction factor is supposed to automatically lower the tax rate so tax bills don't jump in lockstep with rising values. The idea is that if your house doubles on paper, your tax bill doesn't double with it. sounds reasonable. But there's a fatal glitch. Once that tax rate slides down to 20 mils per $1,000 of assessed value, the reduction factor shuts off. The protector hits the floor and just stops. No more downward adjustment. The mechanism that's supposed to shield you from huge spikes disappears exactly when home values are exploding the fastest. Here's how that plays out. High-value suburban districts that already have strong tax bases often never hit that 20 mil floor. Their rates can still slide down when values surge. A 35% jump in assessed value in those areas might translate into just a 5% bump in the actual tax bill. Meanwhile, lower-value rural and ex-urban areas, where a lot of seniors live, hit the 20 mil floor and stay there. In those communities, the same 35% value increase can mean a 25% or more jump in the tax bill. In other words, the zip codes with the least financial capacity take the biggest hits. Seniors in modest neighborhoods get slammed. Wealthier districts stay cushioned. The system functions like a punishment for living in the wrong county. But the broken safety valve is only one layer of the problem. The next is more mundane and just as destructive. Bad data. County assessment records are riddled with errors, wrong square footage, incorrect age of the structure, garages listed that don't exist, improvements nobody ever built. Each mistake quietly pushes your assessed value higher and your tax bill up with it. Most homeowners don't find out until they open the envelope and see a number that doesn't make sense, with maybe 2 or 3 weeks to mount an appeal. Take Kathy in Washington, D.C. A classification error on her tax records triggered 2 separate tax lien sales and added roughly $10,000 to her tax burden. She's now fighting to keep the home she already owns because the assessor's office slapped the wrong label on her property. There is an appeals process, but it's slow, confusing, and has success rates in the 30 to 40% range. Most seniors don't even realize they're allowed to challenge the assessment. And even if they do, tight deadlines and paperwork labyrinths are brutal for anyone wrestling with health issues or cognitive decline. That brings us to the third piece of this perfect storm. Seniors who own their homes outright are uniquely exposed. When you still have a mortgage, your loan servicer sets up an escrow account for property taxes. They monitor the bills and make the payments, because if your house goes to tax foreclosure, their mortgage lion gets wiped out. They have skin in the game, so they protect their collateral. But once the mortgage is gone, there's no bank standing between you and the county, no institution keeping an eye on the tax notices. You're on your own. Combine that with fixed income. Social Security and pension checks don't keep pace with real inflation, and they definitely don't increase 24% in 4 years. Meanwhile, your insurance, utilities, food, and healthcare costs are all rising with the broader economy. Younger homeowners under pressure can try to refinance, pick up overtime, start a side business, even sell and relocate if they have to. Most seniors don't have that kind of flexibility. They can't easily turn their illiquid home equity into cash without entering into complex financial products they barely trust. Then there's cognitive vulnerability. Dementia and Alzheimer's turn a paid-off house into a liability. A missed envelope, a forgotten payment, a confused conversation at the county office. The system assumes constant attention and competence. Real life doesn't work that way. Gloria Gaynor's story is exactly what happens when a 91-year-old with dementia runs into a tax collection machine designed for people in their prime. Now let's talk about the players quietly positioning themselves to profit from all of this. While seniors are losing homes, investment funds are building a business model around tax foreclosures. Counties, desperate to plug budget gaps, sell tax liens to recover unpaid taxes. Investors buy those liens for the amount owed plus fees, often somewhere between $200 and $5,000 on properties worth $150,000 to $300,000. From there, it's a rigged game. If the homeowner manages to pay back the overdue taxes plus interest within the redemption period, the investor pockets returns in the 15 to 25% range, backed by a government lien. If the homeowner can't redeem, the property moves toward foreclosure. At auction, that same investor can scoop up a $200,000 house for a few $1,000s, then flip it on the open market for 2, 3, even 5 times what they put in. Heads they win, tails you lose. The more sophisticated firms aren't just buying random liens, they're mapping county reappraisal schedules, demographic data, and age distributions. They're circling neighborhoods with high concentrations of senior homeowners, recent gentrification pressure, and aggressive reassessments. The 2026-2028 window is basically their target zone. When the next set of reappraisals hits, counties already stretched to the limit. This creates a nasty feedback loop. As more seniors get pushed into tax foreclosure, those properties hit the market and temporarily support home prices or rental inventory for everybody else. That makes the underlying wealth transfer less visible. Meanwhile, institutional buyers start treating senior-heavy neighborhoods the way lumber companies treat forests, as something to harvest on a cycle. And here's the part that almost nobody talks about. There are tools on the books that could save a lot of these homeowners, but they're badly designed and badly used. 16 states offer some mix of property tax exemption or deferral for seniors. In theory, these programs are the shields. In practice, about 60% of eligible seniors never apply. Not because they're too proud, because they never hear about them, or they're confused by the rules, or they miss the deadline by a week and have to wait another year while late fees and interest stack up. The deadlines are all over the place. Ohio's homestead exemption applications are due September 15th each year. Florida's homestead filings are due by March 1st. Texas's over 65 exemptions have an April 30 cutoff. New York's Star exemption has a March 15th deadline. Miss those and you're simply out of luck for that tax year. Income limits are another trap. Many programs cap eligibility around $50,000 to $75,000 in annual income. That excludes upper middle class seniors who don't qualify for relief but also can't absorb a 25% jump in their tax bill without shredding their retirement plan. New York's SCHE program helped just over 53,000 seniors in fiscal 2024, but estimates say more than 130,000 qualified. That's the same 60% underused pattern we see everywhere. Help exists, but the people who need it aren't reaching it. When seniors finally stumble into the system, the solution they're most aggressively pushed toward is the reverse mortgage. On paper, it sounds perfect. Tap your equity, stay in your house, let the loan pay your property taxes. In reality, it's a complex, expensive tool that only fits a narrow slice of people. Reverse mortgages make sense if you've got at least $200,000 in equity. You're planning to stay put until you die, you accept that your heirs will inherit less, and you fully understand compound interest. The real numbers aren't pretty. Origination fees run 2 to 5% of the home's value. Closing costs can hit $8,000 to $15,000. You're charged ongoing mortgage insurance premiums, interest compounds every month. On a $300,000 home, you could easily burn $15,000 to $25,000 just getting the product set up. If you're using that loan to cover, say, $4,000 a year in property taxes, you need several years of stability before you break even. If a health issue forces you into assisted living after 3 or 4 years, the cost can outweigh the benefit. For some seniors, a HELOC or other line of credit might be cheaper if they can still qualify. Most can't. This crisis doesn't just hit the elderly, it reshapes the entire housing market for renters and first-time buyers too. When seniors are forced into tax sales, you get more inventory on the market. More inventory typically pushes prices down 5 to 15% in a region. That sounds great if you're a buyer, but only if you understand the tax side of the equation. Take a $400,000 house at 7% interest. Your principal and interest might be around $2,700 a month. Property taxes at an effective 0.8% rate add about $287 a month at first. After a major reappraisal, that same bill might jump to $400 or $500 a month. Stretch that over 30 years and you're looking at an extra $70,000 to $180,000 in total cost that most buyers never calculate. People run the mortgage number, almost nobody runs the future tax number. If you're over 55 and already own a home, you need to know exactly when your county last reassessed and when the next reappraisal is scheduled. If your market has seen 30% price growth since the last assessment, and you live in a state with 20 mil floors or aggressive reassessment cycles, you are at elevated risk. Now is when you double-check your property records for errors and apply for every senior tax relief program you're eligible for, not when the sheriff's notice hits your door. Now let's deal with the pushback. A lot of people will say the solution is simple: abolish property taxes entirely. And that argument has weight. We're taxed from every angle, and property taxes are uniquely dangerous because they can physically separate you from your home. Right now, property taxes fund about a third of K-12 education plus local services like police, fire, libraries, roads, and sewage. Kill those taxes and you have to replace that revenue with something else. Sales taxes, income taxes, fees, or a combination. Each alternative has its own landmines. High sales taxes hammer low-income families hardest. Aggressive income taxes require strong state-level collection and enforcement systems many places don't have. But when a 91-year-old woman can lose a $250,000 home over a $3,500 tax bill, something is fundamentally broken. At that point, you're not talking about paying your fair share. You're talking about a government-backed system that can strip you of private property because you didn't keep up with an ever-moving target. Maybe the question isn't, do we need property taxes? Maybe it's, is this form of property taxation compatible with basic property rights at all? Tweaking the safety valves won't fix a design that lets the state take fully paid-off homes from cognitively impaired people over a few $1,000s. The usual establishment answer is downsizing. Sell the big house, take your equity, move somewhere cheaper. On paper, that looks rational. In practice, it's rarely that clean. Median savings from downsizing might be $100 to $150,000 on paper, but you're handing 5 to 10% of the sale price to real estate commissions and closing costs. That's $25,000 to $50,000 gone on day one. If the new house is in the same metro, your property taxes may not be much lower. If you move far away, you're leaving your support network, your doctors, your friends, and your routines. At 70 or 80, those are not trivial trade-offs. Moving itself carries health risks, especially when mobility is already an issue. Some will argue this affects only a tiny fraction of people. Maybe 0.5% of homes go through tax foreclosure each year, so it's not really a crisis. That view ignores the soft crisis, the millions of seniors who aren't yet in foreclosure but are one tax bill away from it. People spending half their Social Security check on property taxes and housing. People skipping medical appointments or cutting food budgets to stay current with the county. The baby boomer generation is aging into fixed incomes right now. That means more paid-off homes sitting under a tax system designed for working-age earners. The stress you're seeing in Ohio, Florida, and Georgia is an early warning, not the end state. As reappraisal cycles roll across the map, the same pattern will show up in other states. So here's what I want from you. What's happening where you live? Have your property taxes jumped? Are seniors in your area talking about selling because they can't keep up? Drop your experience in the comments. Real local data from people on the ground is how we map where this is moving next. Tell us what you want to dig into deeper. The investor side of tax lion auctions, the reverse mortgage industry and how it targets desperate seniors, the political proposals that might actually help instead of just generating headlines. Because the question isn't whether this crisis expands, it's whether you're ready when it hits your county. The safety valves are already misfiring. The investors are already positioning. The deadlines are already on the calendar. What you do with this information in the next few months could determine whether you stay in your home or end up as another statistic in America's second foreclosure crisis. If this opened your eyes, subscribe, share it with someone who needs to hear it, and then keep learning. The system is not designed to protect you. You're going to have to protect yourself.